Live. Any quiet. Hello, TikTokers. Testing 1, 2, 3. Godric here, your stock market mentor. Tonight, Monday, we're going to talk about stocks and investing in the stock market. And hopefully, you can retire into the stock market while you're still young. That's the goal. I'm going to go over some stocks today and why they're good. I'm going to look over some technical analysis and why you would pick some stocks over others. September 18th, 2023. Monday night, 10:48 p.m. Pacific time. So, welcome. Give me some likes, guys. Help me get some people in here. I'm new to TikTok, so appreciate your support and your help. Okay, so first thing I want to talk about is like this here, the Dow Jones. It shows plus 6 points. Basically, that's just flat, because being like 34,000, 32,000, like you want to look for when it's like up or down 1%, like so that'd be like 300. So it's not down 300 or up 300. It's not really a big deal. They'll say the market's up 50, up 100. It's like not really an issue. So I just wanted to. I got that question earlier. If you have any questions, just ask. You can send a text. I answer questions in the text message. So when you look at the Dow Jones, it's the top 30 stocks or like the pillars of the market. And they equate to like, if you add them all up, it's like, in this case, 34,600. And that's the price of all the shares like combined. And then they have a way that they divide them and give you that Dow Jones Industrial Average, 34,600. Today it's up 6. So basically flat, not really up or down. The market is comprised of around, let's say, 6,000 stocks. That covers the New York, the NASDAQ, and just the New York and the NASDAQ, really. That covers S&P 500 top stocks. So the Dow Jones it monitors the market. It's a indice, and you can gauge if the market's up or down by how the Dow Jones is doing. And the Dow Jones has stocks like Coca-Cola, Microsoft, has Apple on there, it has Nike. So Intel has Intel. So they do have the top big pillars of the market, and that comprises the Dow Jones 30. So it is a gauge, if you will. If the Dow Jones 30 stocks are doing good, that means that the investors are happy, and the people are buying, and the economy is good, basically. Okay, so the first stock I want to cover is Skechers. Why Skechers is important is because, well, first of all, it's a shoe. They make shoes, so it's manufacturing. And if I'm gonna pull up Skechers for you here, I have $47.01. The symbol is SKX. SKX. And it's good because if it's $47, 47.01, and today it was down 37 cents, down 0.37. So you can buy one share for $47. You can buy 100 shares for $4,700, and in this case, $10. And If you get 100 shares of Skechers, you can write what's called a cover call. And a cover call is where you have your shares and you rent them out to the public every month, and you get a premium for that. In this case, we're going to look it up for you. I'm going to look up the cover call for you. So if you did get 100 shares of Skechers, 100 times 47.01, it's going to cost you $4,701. And we're going to look at the option chain now. So now it's September. So we're going to write October. Write the October cover call. And then in October, we're going to write November. In November, we're going to write December. In December, we're going to write January. So, hey, Swizzle. Welcome, Swizzle. Thank you for the likes. I appreciate you. Maybe share the live and give me a follow. I appreciate it. Send your questions here in the text, and I will answer. Okay, so I'm going to pull up the option chain for you on Skechers. And we're going to look for October. You go option all, view chain. So we're going to go October 20th, and that's the monthly. So write down monthly cover call. So like you're going to write the third week of every month. So put third Friday expiration. Okay, so in this case, October 20th. So it seems that it's September 18th. That's 1 month. 1 month and 2 days. Okay, here we go. So the stock is 47.01. So we're going to look at the option chain. The strike is in the middle. On the option chain, when you pull it up, left side is calls, right side is puts. In the middle, you have the strike. In this case, we're just going to look at the calls on the left side. And then the strike is the middle, which is the option. The specific option. Like every stock, like Coca-Cola, Intel, Microsoft, every stock has like 1,000 options to it. And I want to show you the actual option that you're going to use to write that cover call every month. And that's going to give you the monthly income. Okay, so pull up the option chain. And since the stock is 47, we're going to look at the 48. Because that way, for example, we buy it here at 47. We write the 48 cover call, which means we agree to sell it at 48. And here it says 125 to 140. Now, if it's 125 is the bid and 140 is the ask, I'm going to write it down here. Bid 125 to 140. If you do a market order, you're going to get 125, which is $125. And that's for writing the cover call. But you can do a limit order, like since that's a 15 cent spread on the bid and the ask, 125 to 140, you can probably get about 130 or 135 limit CC. So be willing to put a limit order to get your best price. However, if the market moves against you, meaning that if the stock is coming down, for example, then you're just going to have to do a market order. In this case, you get the 125. And so if you put a limit order, let's say 130, that gives you $130 for writing the cover call. And remember, your investment is $4,700. So what you do is you look here. I'm going to put the calculator. And what you do, you take the premium, in this case, 130. 1.3, and then divide that by the share price of 47.01, and we get 2.765%. I'm just going to round it down to 2.77% return. So for 1 month, you're going to get a 2.77% return. And if you think about it this way, if you can do 10 cover calls in a year, you can actually do 12, but if you did 10, right, that's going to be about 27.7% return. And those are the kind of returns that are going to be able to retire you into the stock market. Because if you can get together, 100 grand, 200 grand, 300 grand, a million, for example, that 27% is $270,000. So those are the numbers we're looking at. On 100K, questions in chat. Should I focus on trade time hourly? I teach to do monthly trade. Hey, Red Cat. I teach to do monthly trades. In this case, you're doing cover calls once a month. If you're doing hourly, you're doing like high profile day trading. Very difficult, because in a day the market can move either way. It can move up or down. It's kind of random, and that's difficult. You can see, for example, a trend going down, Red Cap, or going up, and you can trade that trend. You can buy low, for example, sell high, but it's tricky on the daily. So I don't recommend day trading. We all do some trading, but I'm teaching tonight about monthly cover calls. Okay, and that way you can do trends. Like if your stock is going up over time, you're going to take advantage of those trends over time. And then if your stock is good, it'll go up over time, you'll make money. You don't get that advantage when you do day trading. Okay. So I spent $400 on beer alone a month, bro. So I'm slowly switching to stocks, trades, or invest. Yeah, dude. There you go. For $400, that's your beer. That's your beer money, right? So in that case, you'll need to do. So if we're getting $130, right? You're gonna want to do 3 cover calls, about 130 times 3 equals 390. And then you'll need 300 Skechers shares. So 4701 times 3. Do the math for you here. 4701 times 3. You're gonna need 14 grand, bro. 14 grand, because they're gonna get you $390 a month, which is 3 cover calls on Skechers. That's your beer money. Hey, gotta start somewhere. Gotta start small. Get that money together. Start saving. Sell all the shit in your garage. Do what you gotta do. I'm gonna show you a stock that can do better than Skechers, but I want to start with Skechers because Skechers is a good foundation. It's a smaller stock. Okay. So invest anywhere, but I'm starting with options. Yeah, I'm teaching you today about cover calls. That's what I'm doing. Okay, so back on the CC or cover call, we're going to get 130 on a limit order. 125 is the minimum, but 130 on limit order for a Skechers cover call for October. So again, you buy the 100 shares, you put sell 1 call option 48 for October 20. And that way you get the stock is 47. So we agree to sell at 48. We got 1 point of share growth. So we can get an additional $100 for owning the stock. Stock goes up. That's $100 because we agree to sell at 48. And for the 48 we get 125 bid, but 130 limit. Like I said, they'll probably take that. Now we can sell a 47 cover call, in which case we're going to lose 1 penny or $1 on the share growth, because if the stock sells for 47, which we agreed it will sell for 47, we buy it for 47.01. So in that way we lose the share growth. So I don't like to do cover calls without share growth, but in this case they're going to pay you 175 by 180. So that's even better. So that gives you more money. Like if you wanted to do the return on that, you do 1.75 divided by the share price of 47 equals 3.7%. So in this case, you're going to get 37% a year. But problem is, that's not counting the stock can go down. So your stock can go down, and you can lose money on the share growth of your stock. Like any investment, let's say you're investing in apartments, if you're in real estate, houses, whatnot, the housing market, the value of the investment can go down. Like the housing market might be down 10%, for example. So your investments are down 10%, but you're writing the cover call. You're bringing in income. In this case, let me do the math for you again. We're going to do October, cover call for Skechers. October 20th, strike 48. Going to get 130 on a limit order. So 1.3, divide 1.3 by the share price, 47.01, which is your cost. You're going to get 2.76 or 2.77% return. And that gives you $130 a month for a $4,700 investment. And that's Skechers. So I like Skechers. One of the things about Skechers, it's a manufacturing company. So they have a product. We all know about Skechers shoes. I'm going to pull it up right now for you. If you look at the 10-year chart, Skechers has a good chart. I'm going to pull up the 10-year chart. That's what I look at when I do stock selection. So here I have 10-year chart. It was about $10 10 years ago. And now it's about almost 50. Let's say it went up 5 times value. So when you look at a stock to invest, pull up the 10-year chart. A couple things. One, you want to know that the stock hasn't been trading for 10 years. So that's important. So it's like it survived the test of time. And then 2, you want to know that the company has made money in 10 years. So in this case, it's going from the bottom left to the top right. It goes up over time, which means it's proven itself. It's made money. The shareholders, investors are happy. And in this case, I'm seeing $10 back in 2014, 2013, and now it's almost $50. Let's say 5 times value. So if your stock can go up 5 times in 10 years, in theory, it can do it again. It can go up another 5 times. So the stock can technically go to 250 from here. 5 times 50, let's say 250. Probably won't do that, but if the trend continues, it will do that. So that's what you want to do. You want to get stocks that have a stellar performance over the last 10 years. They prove themselves. They pass the test of time. And they also pay a cover call return. And that's Skechers, SKX. Any questions? Invite Holly. Let's see. Come here, Holly. Have any questions for me? I'm your stock market mentor here, Godric. While we wait for her, she's gonna come. Let's do another one. I like Tesla. Let's just jump to the big bang, Tesla, right? Get some money together, get Tesla, and pull it up. Now Tesla is a dynamite stock, TSLA. And I know that because they pay a great cover call return. So this one's $265 and 28 cents. 265.28. Down 911. Look at that, down 911 right there. But if you pull up the 10-year chart, what do we got? 2013, I have like $5. So it's gone up like to almost 300. What is that? 265 divided by 5. 53 times. So like if you had $1,000 in Tesla 10 years ago, it went up 53 times. It went up to $53,000. How long can I hold Tesla and sell it in order to pay less taxes on my return? Okay, so there's a simple answer to that. Like the basic tax question on that is if you hold it for more than a year, you're going to pay about 10% on your profits. If it is profitable, probably will be in a year. But if you sell it in less than a year, then they're gonna charge you like full income on it. So let's say you made X dollars, right? If you sell your stocks in under 12 months or under a year, you're going to pay taxes as if it was income. So if let's say you made 40 grand on your job, and you made, let's say, 10 grand in stocks. Well, if you're trading like day trading, this other guy here is day trading, or if you're doing these monthly trades that I'm showing you, you might end up selling your Tesla because a covered call sometimes it sells at that strike price. For Skechers, it was going to sell at 48, right? So the difference is, I think it's kind of minimal difference, because if you're getting profits, right, then you can appreciate those profits. The cover call premiums, the monthly income we're getting is not really affected by the tax question, because premiums for options are just income, period. But if you're going to sell the stock and you wait, like I said, you sell it in 1 year and 1 day, you hold it for a year, then you're going to pay only maximum around 10% return. That's called a long-term gain, as opposed to paying full commission on it as if it was earning income. Probably about 22%, like on the new Trump plan, 22% tax on the income if it's with less than a year. So there you go. If you had your stock and you have profit, and you're in the 9th, 10th, 11th month, you might as well just wait till 1 year's passed before you sell it. That way you get the long-term gain, so you pay less taxes on it. Check with your tax guy about that. What's your take on lending? You mean like borrowing money to do stocks? I think the cap was like 60. I don't know about retirement questions. But if you're borrowing money, the main thing is like you could lose money doing stocks like any other business. So be careful. I would say if you can pay that monthly, you can pay the monthly payment on that loan. Let's say a bank loan, credit card loan. Hopefully it's a low interest business loan. Then you can play with it because we know you can pay the monthly on it. But if you have to, like, for example, pay the monthly out of your stock trades, I wouldn't do it, because then if your account goes down, then you're making less money, and you're like, say we have a correction, then like you're taking money to pay back the loan. You need to have the income like from a job or from a second source of income to pay off a loan. And if you can do it that way, then I would say go for it. Okay, so Tesla. So it went up 53 times in 10 years. So right there you have a 10-year chart. You have a performance. You have a huge gain. Investors are very happy. And in theory, it could go up another, who knows how many times in the next 10 years, right? Electric cars. Guys, I appreciate you giving me some likes. Get some more people in here. Welcome, Sunshine. Welcome, Red Cap. Welcome, Lop. Okay, so VGT is a good ETF. I don't know about VGT. VGT, you had a question there. It does have a chart. Let's see. It does have a 10-year chart, yeah. VTG has a nice 10-year chart. It was around 100 10 years ago. Now it's just over 400, 428. So it went up 4 times. Morning Vanguard Information Technology. So Vanguard's putting together technology stocks, and it's doing good. You got to be careful about these ETF mutual funds, and I'm gonna tell you why. When you see somebody say, or you see someone say, "Hey, look at this BTG, it went up in this case 4 times, 4.3 times in 10 years, or it has a X return, has a great return." What they're not telling you is that there's another 100 mutual funds that have lost money, that have not gone up. They're not telling you about those ones. Think about Vanguard and these other companies, these other big companies, BlackRock. What they do, they have hundreds and even thousands of mutual funds. And what they'll do, they'll switch up all the different, it's like playing DraftKings. They'll switch up all the different mutual funds, so they'll have investments in different kinds of stocks. And the mutual funds that do great, or the stocks that do great, are going to push those mutual funds that have good returns. But a lot of the mutual funds are not going to have good returns. They're going to underperform the market. They're going to lose money. You don't hear about those mutual funds. That's what I'll tell you. So because a mutual fund does whatever 20% return or 10% return in a year, sometimes what happens the very next year, down 5%, because they're not showing you the losers. They're showing you just the winners that do well. So just be careful with mutual funds. What I do, I teach you how to do your own mutual fund, right? So you can do your own mutual fund, which is just to say that, like, I do a core 10 stocks list. So I get 10 stocks that I can get behind, that I can trust, that I can appreciate, that I can study 10, which is to say I focus on 10 stocks that I don't have to look at 100 or 1,000 stocks or even 25 stocks. Like the stocks on my core 10 right now are Skechers, SKX. I'll give them to you. Netflix, NFLX. Tesla, we're doing Tesla right now, the cover call. I'm going to tell you about the cover call for Tesla in a second. Tesla, that's 3. Apple, 4. AAPL. 5 is Starbucks, SBUX. 6 is Philip Morris, PM. 7 is Whitehorse Financial, WHF. 8 is IEP, IEP. 9 is Chipotle, CMG. And 10, what's 10? Palo Alto, PANW. Palo Alto Networks. So those are my core 10 right now. I switch them around every couple months. Had to dump the weakest one and bring on one that I think is going to do better. But I've been on these for many years, so I think they're good. Skechers, Netflix, Tesla, Apple, Starbucks, Philip Morris, Whitehorse. Whitehorse and IEP are dividend stocks. Put a D there. Philip Morris is a dividend stock. Put a D there. Chipotle, Palo Alto. Skechers is a CC. Put a CC for cover call. Netflix, CC. Tesla, CC. Apple, CC. Starbucks, not a CC, a dividend. DIV. Also, I have an 11 stock, Coca-Cola, KO, but that's the dividend stock, 11. But I want to focus on 10 today. CMG is a share growth stock, SG. And Palo Alto, PANW, is a CC cover call. Okay, so back on Tesla, I want to show you how to do Vanguard. That's go option, isn't it? Return consolidate. Yeah, I guess I don't know about that particular ETF, but it's doing great. Over time, it's doing decent. Philip Morris is good. Yeah, Philip Morris, good dividend stock. Yeah, let me pull it up for you. It's about 5% dividend right now. They pay $1.27 per quarter per share. I know that much. 5.43% return. So the thing about dividend stocks is, and high paying dividend stocks is that you can get together $1 million, for example. If you're getting 5.4% dividend, that's 54,000 a year dividend, and you can live off that money. That's why it's good. And with dividend stocks, you just hold the shares. Those dividends fall right into your account every quarter, for example, and you can just live off the money. Dividends are taxable, so it's like income, but you can probably have some write-offs. They're good at $5 million gets 54,000 a month. $1 million gets 54,000 a month. $5 million will give you 250K. Oh, a month. I'm sorry, 54,000 a month. Well, let's do the math. 5 mil, right? 5 million times 0.0524. $262,000 a year. If you divide that by 12, we'll divide it by 12 for a monthly. 21,833 a month. So not bad. Did I do it right? 21,000 times 12 equals $262,000 a year times 0.0524. So let's say $5 million again times 0.0524 is 262K a year, and that's 21,000 a month. That's right. Philip Morris. There's other stocks that do that, but not that many. So that's a good one. Philip Morris International is cigarettes, tobacco, worldwide, 180 countries or whatever. Yes, that's correct. 21,008. 262 divided by 12. If you want to do monthly on that, $21,833 a month. So, dividend stocks, right? You basically get paid while you sleep. You're just sitting there, hold the shares. In this case, Philip Morris pays every quarter, every 3 months. But if you divide by monthly, it's 21,000 a month. Every quarter, it's going to be 3 months. It's going to be times 3. 65,000 a quarter, and then that times 4. 262K a year. So you get paid while you sleep. You don't have to work. You just kind of hold the shares and get that money. You don't got to pay taxes until the next year, so you can have write-offs. Check with your tax guy. If you make if you do a paycheck 9 to 5 job, whatever, they take the taxes right away. They take Social Security. They take state FDIC. So you get less money, but with dividends, you get 100% of your dividend. The whole thing comes in. You don't got to pay taxes until you file your taxes. So by that time, you can invest the money. You can get write-offs. Check with your tax guy. That's why it's like owning your own business. So I always recommend, if you can, own your own business. A job is a stepping stone, right? You don't want to do that your whole life, because when you have a job, you're paying taxes right off the check. You don't even get your whole check. Taxes come out right away. Now, a lot of people do get a tax refund. If you think about it, you're getting the money back after you've already given it away to them. So it's kind of you lose the time. If I'm showing you how to do monthly cover calls, you're getting monthly return. You're getting a monthly cover call on your income. You're getting income on your investment. All right, so Tesla. We know Tesla went up 53 times in 10 years. TSLA. I'm doing a cover call on this one. Pull up option chain. All right. Range near the money, put all for options. All right, so it's September, so we're going to write October. We're going to go out 1 month. If you guys can, get your journal out or a notepad. Tesla's 265.28, down 9.11 today. But if you write the cover call, you get together 26,500, 528, and you get 100 shares of Tesla today. And then you can write a cover call. So I'd like to write if it's 265, I'd write the 275, the 280. I write the 277. No, I write the 275. That gives you 10. I write the 277. 277 strike for October 20. And that way, you're going to agree to sell it for 277. That's 12 points of share growth. 12 points SG. And that way, if the stock goes to 277 or higher, it will sell for cash. You'll get 277, so you'll get that profit, 12 points. But the more important thing, you'll get the premium, which is, get ready, ta-da, 1150. I'm sorry, it's a 277.50 strike. 277.50. Get that 50 cents in there. And then for that, your premium is 1150. It's 1150 by 1165. Now let's do the math, shall we? 1150, so you get your calculator. 1150, 11.5, and divide that by the share price. 11.5 divided by 265.28. 265.28. We got 4.335% return. 4.335% return. Let's just say 4.3 or 4.4 per month, right? And if we do 10 cover calls in a year, which I know you can do, that's going to be a 43% return. So now, on $1 million, we get 430 grand. Let's do the math on that. For $1 million at 43% return, that's 430 grand a year. Divide by 12, and I get $35,800. So, in theory, put $1 million in Tesla, you get 4.4% return a month. You can take 2 months off, do the monthly cover call. You're going to get $35,800, $35,833 a month. 4.3% return. Whether that's $1 million or $100,000, or even if it's 26K, 26,500, gets you 100 shares of Tesla. The cover call pays $11.50, so it's $1,000. It pays $11.50 per share, so it's $1,150 a month. So $1,100 a month. I mean, that could be like a mortgage. That could be like a car note, food money, So I'm showing you cover calls because cover calls are arguably the best strategy in the stock market, or one of them. And you're gonna basically buy 100 shares of a stock, and you're gonna buy a great stock. You're gonna, not just any stock, it has to be a good stock. Tesla, Skechers, Apple, Netflix, right? You're gonna write the cover call for the following month. You're gonna go out 3 weeks. The third Friday expiration every month, and you're gonna get between, let's say, 2 and 5% return. And that's what you're looking for, 2 to 5% return. And most of these good stocks are consistent. You can do them every month. You're looking for volume, heavy volume. looking for a 10-year chart that has a good return over 10 years, looking for a good share price, a healthy share price. Higher price stocks I like better. Lower price stocks, not so much. Welcome, guys. Give me some likes, man. Support the live. Appreciate your help. I'm new to TikTok. I'm Godric, your stock market mentor. So we did. Anyways, $1,100, $1,150 is like decent money, right? For an investment of $26,500. So just let that like marinate in your mind. Like we did Skechers, it was $4,700 investment, like under $5,000. It's bringing in $130. It was a 2.7% return. Not that great, but decent. Tesla, 4.4% return. 26K investment, much better. It's almost double, right? And $1,150 on the monthly cover call. So the cover call, to say it in a different way, as apartment owners can own the apartment and rent out the rooms for X dollars a month, a stock market investor can buy lots of shares, 100 shares at a time, and rent out those shares to get this premium, which is called the cover call. You're renting, you're selling the option, you're writing the option on your shares every month, in this case, what I'm showing you. And that brings your income. So that's my analogy. Hope you like that analogy. Let's do one more. I'm going to call it a night. And if anybody has questions, send me a question. I'll try to answer your questions. What's the math at 10 purchase for a monthly? Are you here, Red Cap? The math for the dividend. I just did that. Didn't we just do Philip Morris? $10 purchase monthly dividend. Let's just review the dividend on Philip Morris, and then we're going to go to our third stock. So Philip Morris stock, not the cover call, but the dividend, PM symbol. I'll pull up for you. PM. 96.96. PM. 96.96. Plus up 117. And they're going to pay 5.43% return. That's for the year, right? And then let's just start with 100K, because dividend stocks, you want a little more money. 100K. So 100K, 100,000 times 0.0524. It's $5,240. Did I do it right? Oh, 543. Sorry, 543. A little better. 100,000 times 0.0543. You're gonna get $5,430 a year on your Philip Morris dividends on 100K, and divided by 12, you get $452 a month. So not bad. Like I said, when you have the dividends, not the cover call, but the dividends, you just hold the shares. There's no trading like the cover call. There's no trading on dividends. You just hold the shares, get the dividend. And like, nothing's guaranteed, right? So they could slash the dividend. I mean, some companies have slashed their dividend, but I happen to know that Philip Morris has not slashed the dividend in like 20 years. They've been doing great. They've been very consistent, profit, hand over fist. So I happen to know that they increased their dividend. Matter of fact, the dividend increases more than inflation, so it even keeps up with inflation. Like they were paying like 127 now. They were paying like 120 about a year and a half ago. So they'll raise their dividend every so often. So on 100K, you're gonna get $452 a month and $5,400 a year. And on $1 million, just add a zero to that. $4,500 a month and $54,000 per year. Got that. Okay. Questions? Okay, let's do one more cover call. We'll call it a night. I like Palo Alto Networks. Let's pull it up. PANW. Very close share price to Tesla, $239. So PANW. This one's a technology big one for a long time. $239.89. Down 31 cents. Okay. What I like to do, I like to see a 10-year chart. Chart 10 years. And what do we see? Something like, this looks like we're about, I want to say about $17 10 years ago. And now it's 240, 239. So let's just do the math on that, right? 239 divided by 17. 14 times. So 14 times your money, right, in 10 years. So like $1,000 10 years ago is $14,000 now. So that's the kind of share growth I like to see on a 10-year chart. Check your chart, check your investment. Does it have a 10-year chart? Does your stock have a 10-year chart? Does it make money over 10 years? It should go from the bottom left to the top right, right? And the volume, let's look at the volume. I have average 10-day volume, 2.3 million. So that's a good amount. Volume's good. And then let's do the cover call, and then we'll call it a night. Okay, here we go. You're going to get together $23,989. That's 100 shares. Buys you 100 shares of Palo Alto. $23,989. Okay. And we're going to write the cover call for next month. Option chain. October 20, like I said. We're going to look at all options. And we're going to get October 20. Okay, here we go. Strike. If his stock is 239, I would write let's say 245. Yeah. The 245 pays 540 by 560. The bid is 540. Ask is 560. So we're going to get $540 or $5.40 per share. But for 100 shares, you're going to get $540, $540. And the strike, we're going to agree to sell the stock at $245. $245 strike. Okay. So the stock's $239. And the change, the cents, $239.89. Just say $240. And we agree to sell at $245. That's $5 a share go. So we're looking to get even $5 more if the stock goes up $5. And then on the cover call, it's going to pay $540, so 5.4. Let's do the math, shall we? 5.4. 5.4 divided by the share price of $239.89. 239.89 equals 2.25% return. Not bad. Less than Tesla. Tesla was up 4%, like twice so much. But you're exchanging, like, I'm going to say Palo Alto is a little more steady than Tesla. Tesla's kind of like roller coaster. So you're getting $540 out of a $23,989 investment. That could pay your car note. That can pay for food, for example. Ideally, you don't want to put all your money in the same stock. So, like, if you're doing a core 10 stocks list, you'll have like Palo Alto, PAMW. You'll have Tesla, TSLA. And let's say you have Skechers, SKX. So you got 5K in Skechers. You got 25K in Tesla. You got 25K. About 55K. 60K, you can do Skechers, one cover call. You're going to get 130. Do one call for Tesla. We reviewed that. You're going to get 1150. You're going to... we're going to do one call for Palo Alto, get 540. So just like you just like add up that premium. Let's add those premiums here. 1150 plus 130 for Skechers plus 540 for Palo Alto equals 1820. So with 60K, Skechers, Tesla, Palo Alto, 100 shares of each, cover call on each, get $1,820 a month. And if you want to do 1820 divided by 60,000, you get 3.03% return. 3.03% return per month, or 30% return a year. So with 60K, for example, in these three stocks, you get $1,800 a month on the cover calls, 3% return per month, 30% per year. You're doing okay. $1 million, you're getting 300 grand. 100 grand, you're getting 30 grand a year. And with 60 grand, you're getting 1,800 per month and 18, 20. I just do it times 10 because make it easy. I allow for some loss. So 18,200 per year on 60 grand. On 60 grand. Okay, any questions? Is that a wrap? I'm going to do these lives on TikTok for stock market every Monday, so join me on Monday night. Give me a follow. When you come on, support the live with some likes. I appreciate it. Share if you can. Send me your stock market questions. I'm teaching how to retire into the stock market. That's what I do. I've been doing that. I'm here to help. I'm your mentor. Just ask a question, send me a message. I do, portfolios, trades. I advise on trades. I do text mentoring. Thank you so much. Appreciate you. See you next week.